The ATRAM Alpha Opportunity Fund Incorporated has one mission: to look for the winners of tomorrow. The fund actively finds the fastest-growing Philippine companies with high-quality management and sound business strategies. This growth has often translated to higher stock prices. The fund has a proven track record of selecting companies outside the Philippine Stock Exchange Index that were eventually included in major indices, while most funds in the market stay within the Philippines' top 30 companies. This has led the fund to consistently outperform the market in the long term. Furthermore, the fund invests in long-term drivers of growth that could provide significant gains for investors, such as technological advancement, tourism, infrastructure, and sustainability. Invest in the potential of the best growth stories the Philippines has to offer. Invest in the ATRAM Alpha Opportunity Fund Incorporated. For more information, visit www.atram.com.ph. What is a bond fund? Why invest in a bond fund instead of directly investing in bonds of actual companies? Corporate bonds are borrowings of companies to help finance their operations. In general, bonds are interest-bearing investments. You earn interest when you buy this particular investment. Think of a single corporate bond like a plant. It grows over time and blooms. Meanwhile, a corporate bond fund is more like a garden. A garden is more satisfying than a single plant. It contains different types of plants and flowers that are carefully picked and monitored by gardeners. They are studied every day to ensure that they will grow and bear fruit. The ATRAM Corporate Bond Fund is designed similarly. Recommended to investors with a moderate risk appetite, the fund provides you returns like that of a corporate bond but invested into multiple corporate bonds, providing you more safety in case one of the multiple companies are unable to pay. Diversification is ensured to make the fund more efficient and stronger than owning a single bond. The fund pays regular annual dividends, providing you with a small stream of income. Unlike a corporate bond, the fund provides you liquidity without sacrificing the price. And lastly, the fund is actively managed and constantly studied to minimize the risk of the fund losing money. Invest in corporate stability. Invest in the ATRAM Corporate Bond Fund. For more information, visit www.atram.com.ph.
Good day, everyone, and welcome to our webinar. My name is JP Chong, Business Development Manager, and I will be your host for today. The beginning of this year has been erratic. Investors are on edge as a result of a sharply inverted yield curve and a developing bank panic that has already claimed a 167-year-old Swiss bank, a pillar of Silicon Valley and an odd provincial bank, with strong ties to the cryptocurrency industry. Meanwhile, central banks maintain raising interest rates. The balance sheet of the Federal Reserve is also still getting weaker. In other words, as the fight to stop inflation continues, financial circumstances are getting tighter. In today's second market outlook, Ms. Sandra Araullo, ATRAM's very own Chief Investment Officer, will present ATRAM's viewpoint on the status of the markets and the positioning of various investment strategies. Our objective is to create investment solutions that are suited to each client's unique goals and requirements, while assisting them in understanding the implications of their portfolios. So sit back, relax, and of course, get ready to learn. We do hope by the end of this webinar, you will have gained a deeper understanding of the current market outlook and be better equipped to make informed decisions in the coming months ahead. And of course, as always, if you have any questions, you may send them as early as now by clicking on the Q&A button found below your screen. Before we begin, I would like to inform you all that this session will be recorded and that the links will be distributed and posted on all our social media platforms. Whether you are a novice to the world of finance and investments or an experienced investor who wants to stay up to date with the latest investment news and strategies, we got you covered. Make sure to subscribe to our official YouTube channel. That's at ATRAM Studio, where you can find a replay of this webinar. In case of any of your friends are unable to attend, additionally, do not forget to hit the notification bell as well to receive alerts on all your devices whenever we upload new videos. Furthermore, kindly visit our website, that's www.atram.com.ph, for more detailed information regarding all the funds that we offer. You may also access our official social media pages by scanning that QR code found on your screen right now. Again, we'd like this webinar to be as interactive as possible. We encourage all of you to send in your questions via the Q&A tab throughout the webinar. Additionally, we will conclude a feedback survey after the webinar. We do hope you can participate to share your thoughts on today's session and would provide suggestions on how we can enhance our webinar series. It is indeed a pleasure and a privilege to have with us today ATRAM's Chief Investment Officer, Sandra Araullo. Sandra is responsible for overseeing all investment portfolio-related activities of the firm, including formulation and implementation of strategic and tactical asset allocation decisions, fund and security selection calls, and market risk management for ATRAM's discretionary managed accounts across equity, fixed income, and multi-asset strategies. Sandra is a CFA charter holder and was a member of the Board of Trustees for the CFA Society Philippines in 2017 to 2019. She is also a member of the the Fund Managers Association of the Philippines, or FMAP. With those out of the way, we can now formally start our webinar. Hi there, Sandra. Hi there, Sandra.
Afternoon, everyone, and thank you for having me. And yeah, let's get the show on the road.
Sure, Sandra, the floor is now yours for this one. Thank you again. Thank you very much for joining us this afternoon and to share your thoughts with us regarding the market outlook for the second quarter.
Yeah, so as always, I'd like to start with doing a recap so far of how the markets have performed, no? And the first quarter has been a bumpy ride, to say the least. Global equity surged almost 10% in January. You can see it in the yellow line there. This was brought about by optimism around China reopening, signs of peaking inflation, and a less pessimistic set of economic growth data. It helped fuel the soft landing narrative for the US economy. However, as we all know, the failure of Silicon Valley Bank had shocked markets in March and had caused a sell-off in equities, practically retracing or losing more than 75% of that rally. Government bonds also rallied sharply as investors questioned the soundness of smaller banks and factored the possibility of a pause in Fed tightening. Elsewhere, local markets, we saw Philippine government bonds gain almost 5% for the first quarter of the year. This has retraced about 50% of the 10% maximum drawdown from peak bond prices in the middle of 2020 to end of last year. So long and short of it, we still think that fixed income is set to deliver steady returns in a slower and lower inflation environment. When the banking turmoil ensued in March, we also saw global bonds in orange rally again after markets started to price in Fed cuts as soon as this summer. So we think that in the near term, markets seem to be getting ahead of themselves. And finally, for the PSEI in the gray line, it's been languishing between the middle of the range, the 5.7 to 7.1 range established since mid-2020. So so far, that's how things have been going on in the markets. And I think what we'd like to tackle next is really what is happening in the global macro environment. So the next slide is where I'll walk you through the the effects of monetary tightening to the real economy. So since the middle of October last year, the stock market has rallied almost 20%. And that has questioned, or that has made a lot of investors question whether the economy or the US economy is still on a recessionary path. So the three drivers of that rally, as I already mentioned earlier, had been China's post-COVID reopening, some economic relief from Europe, and also smoother functioning supply chains. But as output ran ahead of the weakening underlying demand, the GDP number for the US had also come in more positive. We think that this how do you say, cyclical relief that we've been seeing in risk markets are really just temporary in nature. Over many cycles, we've observed that economic indicators exhibit a fairly repeatable response to monetary tightening, and that not all sectors of the economy are simultaneously affected. So reaction times to rising interest rates vary from 6 months for the more rate-sensitive sectors such as housing to 12 to 18 months to equities and credit spreads. So we're already at the 12-month point, actually. You probably hear about how stubborn jobs data has been, and this is only because generally we expect that the tightening to reflect into the broader economy and jobs about 18 to 24 months after tightening has commenced. So that puts us at around midway to this 24 months. And that said, we do expect for the US economy to further decelerate into the year. Corporate spending and construction activities have already slowed due to higher borrowing costs. And then you are now going to see, or we now expect to see, corporate investments being pressured by weaker earnings. So the recent banking sector stress also further reduced banks' appetites to lend. So the long and short of it is, as job losses and economic contraction work off the excesses of the past cycle, inflation and unit labor costs will eventually recede and will restart an expansionary phase once again. But one thing is certain, at the moment, the US economy is still well on its path to weaker growth. On the next slide, I'll just give you a sense of how the Fed is not inclined to abandon its primary mandate, which is to tame inflation. So despite the tightening financial conditions, we don't expect the central banks come to the rescue. So right now, bond markets are pricing in rate cuts for 2023, reflecting the old recession playbook where central banks cut rates on signs of economic and financial damage. Yet, persistent inflation means we can expect rates to stay higher for longer, and it's going to be a very tough balancing act for the Fed, especially to manage between, or to try and accomplish a soft landing for the economy, or a mild and shallow recession. On the next slide, you'll see how the fallout from the recent banking crisis has kind of further deteriorated the outlook of the Fed on growth. No? So the divergence between the two lines here is just indicative of this tightrope balancing act that the Fed needs to do. So since February 2022, the Federal Reserve has been predicting for subdued growth and the weaker economy because of the policy decisions. But in the last FOMC meeting in March, they have actually highlighted the heightened risk of a recession. So we just expect that the Fed will take a more balanced view on policy tightening, especially as commercial banks are starting to be more cautious on lending. Despite problems with the banking sector, the current expectations of the market for aggressive rate cuts before the end of the year may actually be premature. On the next slide is just a comparison between the survey of macroeconomic data that we saw during the global financial crisis. So there's a lot of comparisons, especially in the beginning of March, around whether or not we're entering into this GFC-like situation. So I think there are several key features that are still absent, and that is a systematic blowout. Although what happened with SBV is really maybe a warning sign. So we don't think that a repeat of the 2008 financial crisis is in the cards, although the banking turmoil has reinforced that recession view. So as higher interest rates continue and tighter financial conditions persist, we're going to see that hitting the economy as shown by these indicators flashing more red as we go through 2023. Next slide, please. So with the banking sector stress and potential weakening of economic data, we believe that the upside risk to bond yields is now more limited. So this makes taking on duration risk or holding on to longer term bonds offset or the risk of taking on duration being offset by income. Many emerging market central banks, including the BSP, are approaching the tail end of their interest rate hiking cycles, and this will also be supportive of duration risk. The weakening trend also in the US dollar could provide a more favorable backdrop for emerging market fixed income. The BSP has raised interest rates by a cumulative 425 basis points since May last year. And the BSP Governor Medalla notes that they would like to see a continuation of the slowdown in the month-on-month CPI data, and particularly the April print that comes out on May 5 will be critical in giving us an indication on whether the BSP will decide for a rate cut possibility within the year. Next slide. So I guess the bright spot amongst all of the investment asset classes out there clearly is our fixed income or Philippine government securities, but the viable income paying investments are no longer limited to those. We're seeing quite attractive yields also for corporate bonds and FX-linked notes on the higher end of the risk scale in real estate investment trusts or REITs, and high dividend paying equities and preferred shares are also giving us a pretty attractive yield pickup. And so the bottom line here is that locking in high yields that continue to price in elevated inflation expectations will pay off as central banks inevitably move towards easing rates by late this year or early next year once a US recession hits. While we continue to prefer fixed income over equities, with the rising risk of recession later in the year, we still see some opportunities within the equity set. So on this chart, I'm sharing with you some earnings estimates expectations, no? So very flat, or at least practically no earnings growth in the US, and the bright spot for earnings growth is really coming from China, which is not a surprise because they had practically been not participating in productivity since they were in lockdowns for the most part of the last 3 years. The pressure from profit margins and earnings clearly are going to limit equity performance, especially for developed market equities in the near term. Higher rates could also prompt valuation derating for growth stocks, and weaker growth could undermine the earnings outlook further. So on the right-hand side, you'll see an indication of valuations, and relatively, there are better opportunities in EM and China, particularly, versus the US. We do think that there will be some earnings disappointments in the next few earnings seasons, and that will pressure the valuations on US equities to deteriorate from these levels. The bright spot being EM Asia also spills over to our own market. So on the next chart, I just prepared here, or next slide, I just prepared here an indication of the kind of value that we're seeing for our own equity market. So we finished the earnings reporting season just recently, and for the full year, the PSE index grew earnings by 27% for the full year. This follows 43% earnings growth in 2021, which brings us to slightly above pre-pandemic earnings growth for Philippine corporates. So the 27% earnings growth is in line with ATRAM's estimates and a little ahead of the street's own expectations for an 18% earnings growth for the full year. The market has been on this quite wide range for the last 3 years practically, and we really think that a lot rides on what's happening in the global context. But if we try to take out the noise and focus on the fundamental drivers of fair value for the Philippine equity market, we think that for the full year 2023, the market or corporates will be able to deliver 17% earnings growth, a little bit more modest than the 27% we saw for 2022, but enough to bring fair value for the index at around 8,100. This assumes a forward PE of 15.8 times, which is a little bit of an improvement on the 13 times current PE valuations that we're seeing. And between our base bull and bear case scenarios, we think there is a very attractive upside to downside risk. So for our base case of 8,100, that's a 26% upside to a 45% upside if we consider our bull case scenario, where if valuations go up to 17 times from the current 13 times, can bring the market to 9,300. Again, these are just fair value estimates and is trying to weed or take away the noise from what's going on in global markets. To complete the story, we have a downside risk of about 12%, where at 6,400 for the index, our bear case scenario is for a 5,600 level for the PSEI. On the next slide, it's really just a summary of our asset class views for the next few months. We maintain our preference for fixed income over equities, given the risk of higher US rates in the near term and the rising possibility of a recession later in the year. Higher rates could prompt some valuation derating for growth stocks, while weaker growth could undermine earnings outlook further. We like high quality names. We have a preference for Asia and China on the equity side, because it does at the end of the day, even if we are looking at a recession scenario, the wide range of outcomes still necessitate exposure into some pockets of opportunities on the risk side. So we think that in terms of where growth is going to come from, the potential economic downturn in the US can be offset by the bright spot in Asia and emerging markets. And lastly, while we are overweight fixed income and minding our risk on the equity side, we are relatively underweight the most on alternative assets, just because commodity prices are unlikely to reverse or to recover unless we see the stock market sustaining its first quarter bounce. The bright spot on the alternative space is gold, and it appears to be on track to star for the rest of the year. That's it for the second quarter outlook, and I'm happy to take questions.
All right. Thank you very much for that, Sandra. I know our audience right now are excited to ask you questions. We are already seeing questions that were coming in earlier as you were discussing, and there's still questions coming in. But before that, I would just like to give a few announcements to everyone that we are pleased to announce that ATRAM has won awards from numerous major awarding bodies, such as the Best Investment Solutions Provider, the Most Innovative Fund Management Firm, and the Most Innovative Fund Offering Company. These recognitions serve as a testament to our unwavering commitment in creating cutting-edge investment solutions. We believe that our unique approach in managing assets and funds has assisted our clients in achieving their financial goals. As a result of our team's experts' unwavering pursuit of excellence and innovation in asset and fund management, we are dedicated in continuing to push the limits of what is feasible in the investment industry. We appreciate your continuing confidence, of course, and support to all our clients and our partners out there. At this point, we would like to move on to the live questions from our audience. Dialing in back, Sandra. Hi, Sandra. Again, thank you very much for that. We have several questions coming in, and let's take a crack at it. At the first question. So, given the recent banking crisis, could you briefly explain what's happening in the US as of the moment? I know you alluded to this earlier during your discussion, but I guess they want to have that clear picture, explain it to them further. Siguro, we call it laymanize it to everyone. And when we say the Fed wants to wage inflation, to decline, but once wage inflation to decline, how far do you think that we will go on this one?
Okay, let's maybe first part of the question, what's happening in the US? Because interest rates or yields on US Treasuries have moved higher since the Fed started tightening policy. Banks like SBV that are holding these treasury bonds were losing on the mark-to-market side. It's in their books, and they have unrealized losses on their holdings because when bond yields rise, the prices fall.
Yes.
And the problem was the borrower base of SBV was very homogeneous, meaning they're the same type of lenders. So during the pandemic, there was a lot of liquidity, particularly in the tech sector, a lot of venture capital money, and it poured into banks like SBV. SBV actually enjoyed really outsized profits during the pandemic because of the horde of loans that went their way. So when policy rates were adjusted higher, there nagkaroon ng mismatch between the asset and liability side, and it's really a result of these are the fissures, so to speak, the first dominoes to fall. The problem was at that point in March, there was a lot of or there was pronounced risk in the sense that it could have really unraveled quickly, but we saw the Fed step in quite with conviction, in the sense that they put in facilities to help ensure that it doesn't become a crisis of liquidity. And then what happened in the other side of the Atlantic is a completely separate issue, although connected, has to do with a crisis of confidence. That kind of unfortunately happened one after another, and for the entirety of March, I would say, we were all quite nervously watching how that will play out. So fortunately, the acute stress has since dissipated, but what's clear is that the effect of the tighter monetary policy regime is going to be felt more and more as we move through the cycle. And the second part of your question is related to, what was it again?
All right. So the second part of the question was, in terms of the Fed wants wage inflation to decline. So the question was more of how far do you think they will go?
They will go far, which means that we need to see. Actually, we're already seeing retrenchments, diba? Parang especially in the big tech companies that have gone on a hiring spree during the pandemic because of the outsized growth. They're unwinding that. So it feeds into the economy that they're trying to cool on purpose. No, they're engineering this cooling down of the economy that is being seen through the higher inflation, demand-driven inflation. So the wage inflation is really that medyo stubborn pillar that the Fed would like to see come down. And when that happens, it will set the stage for profitability to come back to the corporates, and then more risk-taking as far as putting capital to work.
All right. Thanks for that, Sandra. Actually, we have a question here that's related to, of course, to the Fed. So the question goes, "Hi, Sandra. Given the leading indicators, are you team hard or team soft landing?"
Of course, I'd like to see a soft landing. I think it's sometimes, and I'll take a step back. What happened with SBV actually became a self-fulfilling prophecy. They weren't really um it was a precarious situation for sure, but then things got out of hand and it quickly unraveled. So it's the same with the recession situation, because right now, because of we're seeing easing in financial conditions, or at least because of the banking turmoil, markets are pricing in uh easing in monetary conditions or in monetary policy, which is unlikely. And because of that divergence, as long as there's inflation, the Fed will keep on that hiking path. And if the growth outlook continues to deteriorate while inflation is not yet fully under control, then the probability of a hard landing increases. So right now, perhaps we're still on that path to definitely a recession, but a shallow and a not a protracted one. If in the best case scenario, in the worst case, the possibility for hard landing is still pretty much in the cards.
I completely agree with you. I really do hope so, that we experience that soft landing, because we feel it right now, and as much as possible, we want it to be less, I guess, less stressful for those who are really feeling it, the effects. There are lots of questions coming in, so let's take it one by one so that we'll have more time to really tackle these questions. So I'll go to the next one. What will be the forecast growth of investment for the next 3 to 5 years? Are there any threats that we can avoid?
The threat is recession. You don't avoid it, you manage through it, so when I showed the positioning, the asset class positioning, on one hand, it's a little bit defensive because it's more overweight fixed income, and we're not afraid to put money in fixed income now because last year we saw fixed income lose on principal because of the big move in rates, diba? Mm-hmm. That said, it's actually setting the stage nicely for the next, I don't know, 3 years for investors. You have high rates, positive real interest rates, meaning if you factor in inflation, you're still getting returns, unlike in the past 10 years, it was a negative real interest rate environment. So that gives us a good cushion as we weather through the adjustment in the real economy. And then the markets are already, kumbaga, you're never gonna catch the bottom of the market. It's not about timing the market, it's really time in the market. And when the tide turns, when the Fed pivots from its hiking cycle towards a hold and eventually easing, then that sets a really good runway for risk to follow through on a rally. So the best approach still, and the all-weather approach really, is to spread risk in the most efficient way, and that's really a personal it's personal to the investor depending on your risk profile, etc.
All right. Thank you for that, Sandra. I do agree. And I think most of our audience will be grateful that you really mentioned yung overweight on fixed income. I know you alluded to it earlier that the relationship between fixed income and bond prices are inverse, as when interest rates fall, bond prices tend to go up. Really good stuff. We'll move on to the next question, and we still have lots coming in. Let's get this one. So by any chance, that what happened to SVB and others? So yeah, you mentioned earlier, may happen here in the Philippines, so closer to home. So do you think a bank run will happen here in the Philippines? I think naghingi siguro to ng pangalan if ever meron man or if ever mangyari man dito sa Pilipinas.
None of the systematically important banks. Pero, we're not paying attention, but there's always a rural bank that's being shut down by the BSP because they're not meeting regulatory requirements. So that's where the effectiveness of the regulator comes in. So again, the noise around SBV tends to be to exacerbate the situation, although it's not systematic, meaning it's very specific. It's a very specific mismanaged situation as far as that bank is concerned. So in the Philippine context, a lot of the banks are very well capitalized and profitable actually. In fact, in the last earnings season, it's the banks that contributed to the earnings growth that I shared with you earlier. So certainly not a concern for us at the moment.
All right. Thanks for that, Sandra. At least that's good to know, especially for those banks that we are really aware of, like the homegrown banks, the banks that almost everyone knows. I guess let's move on to the next question. Should we be concerned given that the PSEI, so that's our index, recent significant decline over the previous few weeks? So yeah, of course, we saw the decline of the PSEI. And where do we see the Philippine stocks going from here on?
The thing is, it's like, sige, I guess the best analogy I would have is, it's nakasale ngayon ang Philippine stocks, no, very very attractive discounts to where the fair price is. And what's causing this discount is the negative sentiment. It's not their profitability, because nga, I mean, we're still delivering 17% full year growth. Next year, 27%. Next year, we're expecting 17%. Contrast that with the US that's expecting contraction pa. So flat earnings, no earnings, zero earnings. So just from that standpoint, it's already stock ownership is owning the company. So if the company is making that kind of profit, then that translates to where the price should adjust to. But there are other drivers of price, and there is the valuation component, which is very, very depressed. This is a bit of a technical term, but we're at 2 standard deviations below the mean. So big sabihin, for the last 10 years, the average valuation is somewhere closer to 18 times earnings. Today, we're at 13 times, and that tends to happen less than 5% of the time. I mean, it's a bit of a technical definition, but suffice it to say that it's a really good opportunity to start accumulating. Again, it's not about catching the bottom of the market. It's deploying systematically and in an optimized way, balancing the risk with fixed income. For the regular, individual investor, a multi-asset strategy, particularly our diversified income strategy, is an attractive fund to get into right now, because it saves you the trouble of trying to time when to do what from an asset allocation standpoint. And it encapsulates the strategy that I just shared with you today.
All right. Thanks for that, Sandra. I like this. The next question, na-mention mo na to kanina, especially the inverse relationship between bonds, between interest rates and prices. So I think the next question is more specific to this one. Are government bonds attractive at this time?
Very much so. Very much so. So I showed the yield curve earlier. It's the long end, no? So meaning 10 years and above, they're giving us more than or about around 6 to 6.5% gross. It's unlikely that it will adjust even higher than that because of the demand. So the Bureau of Treasury would issue bonds or will have their borrowing schedule, and we see that the market absorbs that kind of supply on the primary market, and that means that yields on the long end are quite capped. So yung risk of prices of long dated bonds coming off is very low, and then the income more than compensates pa for that risk. So even if there is still some adjustment, the income will cushion that move up in prices if ever. So for sure, a very, very attractive time to get into fixed income.
All right. Thanks for that, Sandra. We have three more questions left and a limited time, so I'll just proceed to these questions. So the next question, first, nagsabi, Sandra, you did a great job in laying out the landscape for the Philippines, US, and China equities. But the question is, what is your view on the relative attractiveness of developed equities excluding the US? So these are the countries such as Europe, Japan, and Australia.
Okay, Europe is a bit tricky. They're definitely I would say ahead. Sorry, are they ahead? No. They're still mauuna ang US mag-recession, we think, no? Although there is already a earnings recession for European corporates. What happened with Europe is pretty interesting in the sense na they were expected to really suffer from a difficult winter because of the energy crisis, etc. It didn't quite play out. So yung cyclical retracement that we saw since October, it's more pronounced for Europe. But with a longer term perspective, medyo we're even less constructive in Europe than we are the US actually. So I guess it's a matter of really watching out where the inflation story and where the central banks, particularly ECB, position. For Australia, as an equity market, we don't really cover it as granularly, but Australia is very tied to the commodity cycle, and because we don't have or we're at the least constructive on commodities for now, it kind of stands to argue that the outlook for Australia equity is also not as bright as compared to the emerging market space.
All right. Thanks for that, Sandra. So the next question, I think, is alluding, ang ganda ng transition kasi sinabi mo, you think that the US will be in recession first. So the next question is, how about what's your outlook in the Philippine economy itself? Do you agree with the government forecasts in terms of the GDP growth and inflation?
Inflation, yes. Growth, we definitely expect there to be slower growth.
Mm-hmm.
Should it be, it's not bad news, it's not unexpected. Kasi remember, we're coming from, it needs to be considered in the context of the pandemic pa din. throughout 2021, 2022, the story has been an emergence out of the lockdowns. And it's only now, or at least since the last quarter of 2022 until now, that we're really picking up momentum on that. So that should support productivity or economic growth. But because the BSP has been tightening, that has served to dampen the demand side that's pushing inflation higher. So it's done its job. The central bank has raised 425 basis points since last year. So that would have dampened the demand side, demand driven inflation. And it would have some consequences on the growth number as well, obviously. But again, we have to consider always, or we can't look at things in a vacuum anymore. It has to be in the context of the global economy, and 6% growth, or 5.5, 6% growth for the Philippine economy is very, very attractive relative to contraction elsewhere in the developed side of things.
All right. Great stuff, Sandra. I'll move on to the next question. And apparently this question is addressed to me. So, hi, JP. Is the concept of investing in mutual funds offered by MP2 or VUL or UITF from a bank or a mutual fund from a financial institution same as what is ATRAM is offering? How are you different and what's in it for us if we choose ATRAM over the others? So that's a very compact question. So let's take it piece by piece. Isa-isahin natin. So first is, how is ATRAM different from a mutual fund in MP2, UITF from a bank, a mutual fund from a financial institution? So these institutions, including ATRAM, we create investment funds for our investors. So may it be a mutual fund or a UITF. So those are investment funds. But what separates us, ATRAM, from these other fund managers or fund providers out there is that we provide a wide range of investment solutions. Imagine meron kaming 30 plus investment funds. And that could cater to any type of investor. So we have multi-asset strategies, income-paying funds, equity funds, fixed income funds. So it could cater to newbies or seasoned investors. And more to that later sa third question. So how is ATRAM different from a VUL? So simplihan lang natin. Simply put, a VUL product has an insurance component to it. So not only it has an investment component, may protection or insurance component, while an ATRAM investment fund is just purely investment. And the last question is, what is in it for them by investing in ATRAM? So by investing in ATRAM, again, I've mentioned, we provide you wide range of investment funds. So we provide you, in that sense, innovation. Imagine you have access to one of our technology funds. We have funds in terms of the healthcare space. We have also funds in the infrastructure space. If you want to invest on global multi-asset strategies, we have that for you. And in terms of wide network coverage, we have lots of partners out there that could provide that access to you easily for as low. Again, I will mention it later later on in our webinar on how easy it is to access and invest in ATRAM. So I hope I answered that question. So for the next, actually, this is the last question. And Sandra, this is for you. I guess you can also tie it up and wrap it up with your last words. The question is ganun na rin eh. So what is your vision or outlook right now in terms of ATRAM investment? In this time of continuing inflation, what will happen to future investments? And how can we attract investors if inflation continuously affects our economy?
Wow, ang daming tanong.
Let's take it one by one siguro muna. What is your vision or outlook right now in terms of ATRAM investments or in ATRAM investment funds?
So, like you were mentioning earlier, JP, we have managed to provide or fill this shelf that will have a product that is suitable for any type of investor and any type of investment environment. What investment environment do we have now? We are entering a recession. Does that mean I shouldn't be invested? No, because to not be invested when inflation is where it is, 7.6%, you're losing money and there is opportunity cost connected to that. So at the very least, you want to be able to keep up with inflation. And you do that by putting money in fixed income government securities. And then it depends on other considerations, your time horizon, your objectives for investment, etc. Then that kind of, kumbaga sa potahe, yung panlasa mo, yung the way you prepare a chicken dish, 'di ba? Has the ingredients that you use and put together very very specific to the need or to the taste. And then what's the next question?
In this time of continuing inflation, what will happen to future investments?
We think that it's setting up the stage is it's setting us up nicely for the next 3-5 years, even longer. I'm sure that even in two years time, those who sat it out and are, or going na natin 3 years, in 3 years time, fixed income markets would have, or being invested in bonds would have returned, I don't know, something like low double digit, call it 12% in 2 years. And then parang, those who didn't put money in bonds are going to want to put money in bonds, but at that point, it's not anymore the right place to be in. It's going to be equities. So those that are in those who have who listen to us and who put money in bonds today will know by then na it's already a good time to rotate into more risk into equities. And in 5 years time, the Philippine stock exchange market you'll hear it in the news, 30% returns. And when that catches people's attention, it's going to be time to sell again. So it's a little bit counter, we kind of be, di ba parang the old adage na parang be greedy when others are fearful and fearful when others are greedy. It applies. That adage applies from a personal investing standpoint.
All right. Thanks for that, Sandra. So I guess last words na lang, Sandra, and for sure. Yeah.
Last words.
Yeah, of course.
Thank you for joining us and for listening in on our views. It hasn't been easy, even for professionals like myself. The markets have been quite challenging, but suffice it to say that our job is to look at the signals and do away with the noise and try to position and help our clients read the economy in the markets, and to help also clients to build their portfolios that will suit their needs. So it's not, again, this is my favorite saying, it's not timing the markets. Nobody can time the markets perfectly, and anybody who has in the past can certainly not repeat it in the future. It's time in the markets and managing it little by little, adjusting, and it's not taking big bets at any given point. It's fine tuning as you get more information, and just staying in the market to be able to reap the benefits of being invested.
All right. Thank you very much, Sandra. Really good stuff. You've mentioned that your favorite quote is nobody really can really time the market, and we should block out all that noise and look for those indicators or signals. At the end of the day, when people ask, it's usually the good time to invest is really now, because you have that long-term aspect or still long-term horizon. And what Sandra has mentioned, na you don't need to make big bets right now. You just do your fine tunings as you go along, as because we don't know how the market will go in the next years to come. All right. So once again, thank you very much, Sandra, and of course, thank you to our audience. We appreciate you taking the time to join us today. Now, did you know for as low as 1,000 pesos, you can already jumpstart your investment journey? Please stay tuned to learn more.
Good day. If you are interested in investing with ATRAM, the leading independent asset and wealth management company in the Philippines, please visit our website, www.atram.com.ph. We have all the details you would need to know about our funds. If you would like to start investing, click Invest Now. For further assistance and account opening, you may email our client services team. If you have more questions, visit the website's Frequently Asked Questions page or ATRAM Academy page. We hope this helps. Thank you.
All right. So whether you're a novice to the finance and investments or an experienced investor that wants to stay up to date with the latest investment news and strategies, of course, we got you covered. Make sure to subscribe to our official YouTube channel, and that's at ATRAM Studio, where you can find a replay of this webinar. And of course, in case of your friends who are unable to attend, they can view this session at their own time. Additionally, do not forget to hit that notification bell to receive alerts on all your devices whenever we upload a new video. You may also access our official social media pages by scanning that QR code found on your screens right now. Finally, we kindly ask for you all to complete the survey at the end of this webinar, as we value your feedback on today's topic. So with that, on behalf of everyone here at ATRAM, we express our gratitude for your participation, and we wish you and your loved ones continued health and safety. Have a wonderful day. Thank you very much.